So today we wanted to talk about this topic, which is beyond ESOPs and how to rewrite your retirement story. Uh, the idea behind this is we felt that there are a lot of people who are working in newer businesses. The way that careers progress are very different from how it was, say, 15, 20 years ago. And ESOPs, as well as working at a startup, these have all become ways to sort of um, create wealth in a new manner. So, how do we sort of rewrite our retirement story in this new context, and how can we make the most of what is coming to us? So, this is tuned primarily towards people who are living in India and working for either global companies or local companies where they're getting compensated outside of like a salary and a bonus. So, without further ado, let me just go ahead and take you through uh, this strategy that we have today. So, the first thing is that the early bird gets the worm, right? A lot of people move into these new age businesses or they move into companies where they are also compensated through stocks or stock options because ideally they are early believers in a company's success story, right? And the ones who start early and who believe early are actually the ones who are likely to benefit the most over a long period of time because with all equity investments, whether you're an entrepreneur, whether you're an investor, or whether you're an employee in a business and you have a stake, all the benefits of equity investing actually start reaping in the longer term over a much longer time horizon. So, getting this compensation, like if you're one of the first few employees in a business, you're likely to be compensated partly in cash as well as through these other stock options or RSUs, right? So this is the idea. If you're an early believer, you are likely to have certain other benefits, and we need to figure out how to make that work for you. So to do this, I'm actually going to take you through a wealth story. And let me walk you through Vijay's wealth story. So he started so basically, Vijay started his career in one of India's top five IT services company. And after a successful career of 10 years, he felt that there was some need for a new challenge in his life. He felt that after a point, he was not really making the kind of career progression that he had imagined that he would make. And that's when he found this new role with a US based tech company operating out of Hyderabad. Right. So this seemed like a fantastic opportunity for Vijay because it allowed him a certain level of career mobility that he didn't have where he was working now. And he had also reached a point of saturation, having worked with different companies in the top IT services sector in India. So this shift was came at the right time. And when Vijay made this shift, there was this issue of compensation. So the salary that he was drawing was about 10% less than what he was earning previously. But to make up for that, he would also be compensated in ESOPs and RSUs. So ESOPs are employee stock options, and RSUs are basically restricted stock units, right? So RSUs tend to have certain conditions, like if you work X number of years with the company, or if you finished certain milestones, then you have access to the RSUs. And ESOPs are essentially options that you can exercise within a particular time frame. In addition to this, Vijay was also entitled to a year-end cash bonus of up to 20% of his annual income. And the company had this interesting policy of an employee stock purchase program, or an ESPP, right? So the way the ESPP was structured was that Vijay would be allowed to contribute a certain sum every month towards stock purchase. And then whatever the average cost was during that period, he would get a 10% discount from that. And every 6 months, he would be given stocks for the amount that he had invested. So at the end of 6 months, he immediately made like a 10% or higher return on uh, the ESPP or like his employer stocks through the ESPP program. So he felt that this was a great sort of way to um, look at wealth creation and make his investments. So for Vijay, basically this new job or his new employment actually meant wealth creation, because for him it was pretty clear that if he had a reasonably good understanding of what his deliverables were, he could easily work towards getting that year-end bonus, and it wouldn't be difficult for him to deliver. After all, he had been fairly successful at doing this in other companies, and he understood the work culture and he understood the priorities. So for him, this was kind of like a written as long as the company did well, right? The second, like I mentioned, was that the ESPP was structured so that he would make a 10% return on his investment every 6 months, right? So in addition to this, we had talked about his compensation, and he was getting some RSUs, which would create, which upon vesting, right? So every 2 years or 3 years, when these RSUs vested, he would have an additional stream of income that was coming into his account. So a lot of this seemed like a different way of earning money, because previously he was only getting a salary, and now he had all of these other options also that were compensating him in different ways, right? So let's inspect this a little bit further and understand what was actually going on. While Vijay was feeling very positive and confident about how this worked, there was something that he needed to pay attention to, which is that he was putting all of his eggs in one basket. His entire wealth creation depended on the fortune of his company, right? So if we look at that, uh, we know that his salary was basically negotiated by the company. His bonus, while there was a component on deliverables in terms of what he needed to achieve and his targets, there was also a factor of whether the company did well. Because in years that the corporate doesn't do well, the bonuses also tend to be lower, right? So this was something that Vijay needed to keep in mind. The third thing is both his ESOPs as well as the RSUs, right, and the ESPP, all of this actually depended on the price of his company stock. If the company stock went up or if the company stock went down, automatically the value of those investments would also fluctuate, right? And the last is, of course, the ESPP is basically his investments. And since he was doing that also, you had a certain level of concentration risk that was building up in Vijay's wealth creation journey, right? So now if we move on to what you need to know about RSUs, right? Uh, I think these are things that people need to understand in terms of how they can structure their wealth creation, how they can structure their financial plans, as well as how they can structure their investments around these things. The first thing to know about RSUs is that you only own them when they vest, right? So while he was getting compensated in RSUs, let's say in 2024, he would own them only in 2026, right? So for that period, he wasn't actually, it's not an asset that he really owned, right? And there were milestones that he needed to complete before he could own the RSUs. The second thing is that kind of reduced Vijay's career mobility, because now if he had to wait for the RSU to vest, then he would have to stick on for another 1 or 2 years. And what happens is every year you get allocated a new set of RSUs. So that cycle kind of is endless. And at some point, Vijay would have to prioritize whether he wanted to get out of that cycle and make that switch, because an RSU is not the same thing as a cash compensation because of the lag or the timeline lag in which you earn the RSU. The third and most important thing is that there are no guaranteed returns, right? The time at which you earn the compensation and the time at which you receive the compensation, that is, by the time your RSU vests versus the day that you get it as a bonus, there can be a significant move in the price of that particular stock. And when that happens, there is no guaranteed return. If you're lucky, the price could move up. if you're not so lucky, the price could move down in that time frame, right? And price movements are natural in every stock. It doesn't have anything to do with the quality of the company. Stocks are cyclical, so you will see these ups and downs, which is an important thing to keep in mind. And like I mentioned, there was an increase in concentration risk because, like we saw in the previous slide, right, all of his eggs were in one basket, whether it was the salary, whether it was the bonus, whether it was his ESOPs and RSUs or the ESPP, everything depended on the company's fortune. So if the company did well, Vijay did well. If the company didn't do well, Vijay kind of fell short on his wealth creation targets. And that's not an ideal situation for anybody because you want to be able to consistently create wealth through a longer period of time and not in lumps, right? You don't want to create wealth for 3 years and then have a period of a lull and then again another 2-3 years where you're able to generate a lot of wealth, especially when all of this is tied to your career. So one thing that you need to know about how RSUs are taxed is that RSUs are taxed as salary, right? So the day that you receive the RSU as a vested stock, that entire income is taxed at your slab rate, even though there's no real cash flow that's coming in, you just have a security. So that tax liability needs to be planned for independently, right? So now I'll just quickly walk you through that same list for ESOPs. ESOPs basically are an option to buy stock. It's not the actual stock. It's just an option to exercise. So you can either choose to exercise it or you can choose not to exercise it and allow it to expire. And similar to RSUs, you also have two levels of taxation here. So the first is when you exercise the option to own the stock, you basically pay a tax at your slab rate for the fair market value minus the exercise price. Now, the fair market value is ideally, if it's a listed company, it's going to be the price at which it's trading on that day, right? And the exercise price is something that you get as part of your option contract. And then now that you've owned the stock, when you sell the stock, you have to pay capital gains, which is basically whatever price you sell the stock at minus the price that the fair market value that you paid for it, right? So that's as far as ESOPs are concerned. So now let's look at the employee stock purchase program. So when does it actually make sense for someone, right? The first thing that we need to note while Vijay did all of this math was that the 10% gain only works if you sell immediately. That is, at the end of the 6-month period, if Vijay actually sells what he has, then he makes that 10% return. If it's just this thing where you hold on to the stock, there's no guarantee in that return anymore because the price in the previous 6 months can be very different from the price in the next 6 months. You need to also be a little bit more smart when it comes to participating in the ESPP because it is a great program. But ideally, you want to look at optimizing those returns by participating in the program when the company is going through a cyclical low, right? This way, you can start buying the stock when it's cheap and you can hold on to it and you can exit when the company comes out of that trough and into the next phase of positive growth, right? So the third aspect is that now that you have ESOPs, you have RSUs, and you have ESPPs, you own the same company stock in 3 different manners, right? So it's not just important to accumulate them because you are going to continuously accumulate as through your contract as an employee, but you also need to focus on decumulating, or how do you position size or reduce this and convert those benefits that you have as an employee into wealth for yourself, right? So if we try to make sense of ESPP cycles, what tends to happen is employees want to participate when they see the company stock price going up. So there's a lot of confidence, there's a lot of buying that happens in the up cycle. But when the down cycle happens, people are worried about how concentrated their positions are. They're worried about compensation coming in from, ESOPs as well as RSUs and what they're going to do with that. And so at the down cycle, they tend to hold on and wait for the cycle to reverse, right? But we need to reverse this behavior a little bit and ensure that we're decumulating in the up cycles and we are accumulating in the down cycles. That will lead to a much better outcome than what tends to normally happen. So one thing that people need to understand is that in the short run, your stock price and your business fundamentals can diverge, right? That's normal. It happens. There's mispricing in the market. That's how a lot of investment opportunities actually crop up in the listed space. But in the long run, there has to be convergence. So if you're working in a company, you have some perspective about how the long-term growth prospects are going to be, right? And if you keep that in mind, then you know that you want to either have a certain level of allocation towards longer term investments and you can follow a more gradual decumulation strategy, or you want to sort of look at these short term divergences and take advantage of them. So now I'll just walk you through the tax impact. So if we're going to look at this, I've already explained how RSUs and ESOPs are taxed twice. So if you have an RSU or an ESOP for a company based in India, the term for which this asset is considered short term is 12 months, right? So anything over 12 months is considered a long term capital asset. So at the time of exercise, you get taxed at slab rate, or in the case of the RSU, when the income comes in, you get taxed at slab rate. And then you pay short-term capital gains at 15%. Similarly, if you hold on to this stock and you sell it after 1 year, then you pay long-term capital gains of 10% for any gain that's over 1 lakh across all your long-term stock exits. Similarly, if you're working for a global firm like how Vijay does, the short-term tenure actually gets extended by another year. So you're actually now have to wait for 2 years before your capital asset becomes long-term. And again, the taxation for short-term capital gains is going to be 30% or whatever your slab rate is, and long-term is going to be 20% with indexation. So if you have global stocks or unlisted stocks, the taxation is pretty similar, right? Except in this case, like you don't really have the ESOP or anything else that's going to be taxed at 2 levels, right? So this is the tax impact. And I just wanted to walk you through something that we had done for an investor, where we sort of started looking at how we could help them through their wealth creation journey, right? So this is, they were working for a listed company, and this is just a snapshot of how their stock performed. So they came to us for a review, say sometime in November, and their stock had corrected significantly. So this was when they wanted to look at, okay, am I doing the right thing? Because it seems like a lot of my wealth is concentrated in this one company. So do I need to sell everything now? Do I need to wait? What is the goal over here? So when we did a comprehensive financial plan for them, we realized that, okay, more than 50% of the wealth was concentrated in this one stock. And regardless of how the stock was performing, there was a need to de-risk for wealth creation. And so what happened was we began this review, and about a month later, the stock had already moved a significant amount, and we decided to profit book for 5%. So we took out 5%. Then similarly, a couple of months down the line, we again booked another 5%, and we started reinvesting these assets in other asset classes so that there was some diversification that we were able to create. Right. And this is an ongoing journey. We felt that the company's prospects for this year have been fairly positive, so there was no need to immediately exit. But this is something that requires continuous monitoring, right? It's not something that you can just do it once and forget about it. And so this is an ongoing story that we are going to be working on. And this is something that we can do for anybody who's in a similar situation. So now this is one of my favorite quotes because it says that all fortune is good fortune, right? And this is because either that fortune is going to reward us or discipline us or amend what we're doing or punish us. And so fortune is either useful or just. And because it's useful, it's good fortune. Because it's just, it's still good fortune, right? So there's always something to learn from what happens. And I think this is a time where Vijay has to decide how fortune should favor him, right? So is he going to look at the ESOPs, the RSUs, and the ESPP as a reward? Is he going to apply some discipline to his approach in wealth creation, which means that he needs to look at strategic planning as well as asset allocation? Or is he going to allow this to become a punishment where he fails to ignore how much concentration risk there is in his wealth creation story? Right. So this is why we were talking about rewriting your retirement story, because you can rewrite your story to have fortune favor you through rewards with discipline rather than to look at punishment. Right. So now what does strategic financial planning actually mean? It means one, that you have goal-based asset mapping. So Vijay became pretty clear about what assets were going towards which goals, specifically how he would divest his ESOPs and over a period of time. The next thing that Vijay needed to do was to look at goal prioritization. So which goals ranked above which other ones, and what were his top three, right? So the minute he knew that, there was a lot of clarity as to what he was really working towards. And then we looked at asset allocation as well as rebalancing, which is a longer term story where you can't overnight change the way your ESOPs or the way your employer stocks are positioned in your portfolio, but it is something that you need to continuously monitor and change according to the cycle. Right? So what was the solution that Vijay opted for? He looked at multi-asset investing because there was already a lot of concentration risk in the approach that he was using. And this basically allowed him to do certain things that he was very comfortable with, right? So he was able to save every month. He was able to minimize his losses in terms of having a more regular and steady compounding journey. He was able to invest at the right asset in the right time. And this was basically all that he really needed. It was his one-stop solution. Right? Now, a lot of people think about investing as, if they pick the right stock or if they pick the right time to get into the market, then they're going to make the best returns. But when there was an important study that was done in portfolio return variability, which basically means how different are returns based on what people think the most important factor is, right? So 90% of what creates return variation is actually asset allocation. And maybe 5% is picking the right stock, right? And less than 2% is being in the market at the right time. So the things that we devote our energy to, right, which is stock picking and market timing, contribute for less than 10% of the overall returns. And if that's the case, isn't it time for us to shift our focus into what actually matters, which is asset allocation? So getting your asset allocation right at any point in the market is actually going to be the swing factor in how positive your returns turn out to be. So why does multi-asset investing work? It suits a wider range of risk profiles simply because of the ability to be more steady as well as not compromising on returns. So when you look at that, it exceeds the moderate investors' return expectations, right? The third important factor is that it allows investors to continuously participate in wealth creation, because now you don't have to worry about, oh, is the market up today? Is the market down today? Do I need to put in some money? Now, should I wait for 1 week for the market to correct? Should I wait for next month? Or this event is expected to happen? You no longer have to do that. Right? You don't have to delay taking action on your portfolio. You can just continuously invest, and there'll always be a right place or a right theme to invest in. So how can you make asset allocation work for you? I think one is to be very conscious of valuations. So while there's always going to be an opportunity, it's also important to pay attention to how much we're paying for that opportunity and whether it's worth it or not. The second thing is to stay away from the crowd. So typically, whenever an asset goes into a performing phase, more and more people start talking about it and more people start investing in, right? And this is where the crowd is. But the real performance actually started long back. So you need to be a little bit early in the game. And if you chase the crowd, then you're going to make very average or actually sometimes even negative returns because you might enter into that asset story a little bit too late in the cycle. The third thing that all of us need to keep in mind is that good things come to those who wait, which means that the patient investor is going to be rewarded a lot more than the impatient investor, right? And lastly, our takeaway from asset allocation is that a little bit of everything works. There's never going to be a bad year. There's never going to be a negative or a year where you have no participation opportunity. There will always be some area for you to participate in. So now I'd like to walk you through our multi-asset product where the magic actually happens in Sphere. So these are testimonials from a couple of our clients. So they're basically talking about how one of them is retired. So she's talking about how this journey has been really stress-free for her, and she's able to enjoy her retirement by doing the things that she wants to focus her time on and allowing this product to take care of the wealth creation part through her retirement years. Um, and I think the other one is basically about how happy they are to be part of this journey. And we have worked with more than 250 investors. So this has been a great journey for us. And we'd like to spread that word and sort of work with more people as we get that opportunity, right? And just to give you a sense of what our performance has been like, if we benchmark against dynamic asset allocation funds, because we're a truly multi-asset of flexible mandate with our multi-asset product, we have outperformed dynamic asset allocation funds on a consistent basis. There have been certain, we've also looked at flexi cap mutual funds because our allocation to equity is fairly high. So it would be fair to look at how we benchmark against flexi cap. And I think only our 1 year performance has actually been overshadowed by flexi cap mutual funds. But otherwise, we've done much better than these things even since inception. We are a relatively new product in the sense that we have only 2 years of return data in this format, but we will be completing 3 years this year, and this is a process that was built over 10 years. So the foundation is fairly strong, and you will see more of that in the future, and we'd like to have a longer track record to show you. So in terms of drawdowns also, we're somewhere between the multi-asset index as well as the Nifty. We're not as bad as the Nifty, but we're a little bit more in terms of drawdowns than the multi-asset index. And this is since inception data. I have performance data from 31st March. So as you can see, we've done reasonably well for investors over a period of time. And these are the key terms of investment. So if you have any questions about what we do, how this works, this is a SEBI-registered portfolio management service. So there is a SEBI-mandated minimum investment of 50 lakhs. We are benchmarked against NSE's multi-asset index. There is no exit load, and we have a flat fee only of 1.5% per annum. And this is suitable for all investors, even though we don't have any exit load. We would expect people to participate for at least one cycle, which would turn out to be 5 to 7 years. It's a great product if you're looking at saving for retirement. It's a great product if you're looking for something where you can continuously participate over a long period of time. And like I mentioned, we have a very flexible mandate, so we can go 0 to 100 in any asset class. And we don't exceed, there is a concentration cap of 25% for any single stock exposure, but we're not that concentrated as a strategy, right? I'd just like to introduce you to everyone in our PMS team. So we have Shamsa, who's heading investments as well as the fund manager for all our products. We have three other co-fund managers, and we have Mr. Niranjan Sridhar heading investment strategy for Sphere. Then we have a research team as well as a strategy team, and we have few other people also who are working on the product management as well as the investment management side. So with that, I'll open up for any questions, and I'll just leave our coordinates here. So in case anybody wants to get directly in touch with our team, you can drop us a message on WhatsApp. Okay, so I'll take the first question, which is in multi-asset allocation, apart from FDs and bonds, mutual funds, PMS, EIF, Government of India bonds, gold and silver, what other avenues exist for the common investor? This is a pretty comprehensive list, but I do think you can add maybe arbitrage funds into this, because that is one category that also has a different asset allocation. The second thing that you could do is possibly even consider global funds and ETFs. But with that, I think that would more or less cover the entire universe. And you have things like sovereign gold bonds, which are basically Government of India bonds, but then it's also like a gold investment, right? Does anyone else have any other questions? Gopi, any questions from YouTube? Okay. So I'll just wait for another minute or so. If there are no questions, then I would really like to thank everyone for joining us today. And it's been great having this conversation about ESOPs. We hope that it added some value to your weekend. And we look forward to seeing you at more of our webinars. If you need anything, please get in touch with our team. So I've left our coordinates here. You can just drop us a message. We'll be very happy to work with you. We also have a bunch of other programs that we're running. So if you're not looking at, let's say, a PMS, and you're looking at something like a mutual fund strategy, we have a team that can help you with that. If you're someone who's being compensated in ESOPs and RSUs, then and you'd like to look at how to plan these investments and rewrite your retirement story, we have a financial planning team that can work with you very closely on making this happen. Similar to how I showed you that example of how we helped a client de-risk, because that's a very important part of unlocking your full potential and realizing your wealth creation. All right. All right, so I don't see any more questions. Thank you, everyone. And with that, we'll close the meeting for today.